all it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. Exceeding $100 trillion, that is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely not merely higher, but much higher gold prices.
In today's news recap, Trump tariffs could have a massive impact on precious metals prices, but not the way many think. TD Securities' Melik. The newly installed U.S. administration's threats of import tariffs as high as 25% continues to roil commodities markets. And while many market participants are focused on potential shortages of physical gold and silver, that's not where the real impact is likely to be felt, according to Bart Melik, global head of commodity strategy at TD Securities. It looks uncertain. I think that's probably the kindest and mildest thing I can say, Melik said. Recently, we had a so-called blowout in the EFP exchange for physical silver and gold markets, and that was all because markets were concerned about what the tariffs might be. At this point, we are not looking at global universal tariffs, though they may also be coming, as was said in the Oval Office the other day. Right now, the focus seems to be Canada and Mexico. But it's not only the metals market, he added, it's also the energy market, which would be much more important to the broad economy than just the metals market itself. Asked about the impact on the U.S. supply chains from the tariffing of Canadian metals producers like Teck Resources, which sends significant amounts of copper and zinc south of the border, Melik said the U.S. administration could be creating an intractable problem for their own industry. We are a big exporter of zinc. That may very well be one of our largest sources of metal exports directly, and the U.S. certainly is a big customer of it, he said. What would it mean? Ultimately, there aren't that many substitutes. You could maybe get it from Chinese smelters instead. Ultimately, it means broadly higher prices domestically in the U.S. and some sort of market segmentation, a global price and a U.S. price. Before we show you more clips, smash the subscribe button and check out our huge discount on NordVPN, the fastest and most reliable VPN on the market. This VPN service is a perfect fit for smart stackers who want their privacy protected and don't want their data compromised by prying eyes. For less than the price of a cup of coffee, secure your internet access and get 3 free months with our promo. Believe me, the only problem you'll ever have is that you didn't get it 6 months ago. Let's get back into the episode.
Of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't in fact been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the U.S. dollar and the weaponization of the SWIFT banking system, which is to say the U.S. government's attempt to use the U.S. dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in U.S. treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your U.S. treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the U.S. dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: Gold is really, really, really underowned historically. JP Morgan Chase suggests that the market share of precious metals and precious metals related securities is less than 0.5% of total savings and investment assets in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by JP Morgan Chase to be 2%. So gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. Go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9,000 or 10,000.
Yeah.
Why do I say that? The last time that we had sustained deterioration of the purchasing power of the US dollar was the decade of the 1970s. In that period, 1970 to 1980, back to arithmetic, according to the Office of Management and Budget, the US dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, what was $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850. And I think passes prologue.
In today's news recap, silver to beat gold in 2025, Saxo Bank's Hansen. Diversified commodity exposure should continue to perform well in 2025 as a hedge against inflation and economic uncertainty. Specifically, gold and silver are expected to outperform the sector. Despite the bullish outlook in his 2025 forecast, Ole Hansen, head of commodity strategy at Saxo Bank, recommended that investors be discerning as they build a commodity basket within their portfolios. Gold and silver remain two of his top picks after their historic runs in 2024. Hansen said he forecasts gold prices to rise to $2,900 an ounce this year, representing a gain of 7% from current levels. However, Hansen sees even more potential in silver, projecting prices to reach $38 an ounce, a gain of nearly 30% from current levels. He added that his outlook is skewed to the upside. Looking at gold, Hansen noted that the precious metal will remain an important safe haven asset through 2025. The demand for investment metals has been fueled by an increasingly uncertain geopolitical landscape where global tensions and economic shifts have led investors to seek safer assets, a development that shows no signs of fading anytime soon, he said. Additionally, concerns about mounting global debt, particularly in the United States, have prompted investors to hedge against economic instability by turning to precious metals. However, he added that investors will need to be patient as the Federal Reserve shortens its easing cycle. Currently, markets are pricing in only one rate cut this year, a sharp contrast to expectations from a few months ago. The U.S. central bank's hawkish stance could support the U.S. dollar, creating some volatility in the precious metals market. Now we'll show you the best clips of the latest interview, but first, like, subscribe, and turn on notifications. And more importantly, let's celebrate democracy's recent victory in America. We're running a 30% off sale at goldsilvermerch.com until the end of the month. We've just introduced price point t-shirts and new designs, so this is the perfect time to get your gear and support the local economy as well. Use the code PRESIDENT at checkout to claim your discount. Enjoy the episode.
Most important thing, don't rely on society to do it for you, because the Commonwealth, frankly, is empty. I mean, just get that through your head. Own gold. Own gold and pray to God I'm wrong. As an investor, as a saver, have gold for insurance purposes. Hope it doesn't go up, but be prepared if it does. If you're an investor, consider buying the best gold stocks. If you're a speculator, look at the penny dreadfuls. There's lots of money to be made there if you're willing to work and take the risk. Beyond that, invest in the biggest and best oil and gas companies, the great dividend payers. Warren Buffett is going to 30% on Occidental Petroleum. How many times has he been wrong? Not very many times in my life. If you are invested in natural resources, take advantage of a free service offered by me. Go to my website, ruralinvestmentmedia.com, list your natural resource stocks, and for free, I'll rank them 1 to 10, 1 being best, 10 being worst. That's free, no obligation, ruralinvestmentmedia.com. I have cash as a larger component of my portfolio than I would like. When I say larger than I would like, I don't like the fact that I'm earning 4% or 4.5% on savings in a currency that's depreciating by 7.5% a year. But I regard the foregone purchasing power that happens holding cash, pardon me, as an option payment. I want to have the liquidity so that to the extent that we have a liquidity squeeze occasioned by the difficulties that I see in the economy, that I can take an advantage of that liquidity squeeze rather than being taken advantage of. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion. That is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely not merely higher, but much higher gold prices.
What do you think? Do you agree with Rick Rule's prediction that silver is set to outperform gold, but only for those patient enough to wait? Is he right that most market commentators are just spouting nonsense and misleading investors with unrealistic hype? Let us know your thoughts in the comments below. Do you side with Rick's no-nonsense approach, or do you think he's being too harsh? We'd love to hear where you stand. Now check this video right here because it's a perfect fit for you. And I'll see you on the other side.